Welcome everyone to Pacific Portfolio Interview Series, in which we help increase the value of time for our viewers by helping them reduce noise, investment inefficiencies, and market chatter around their most precious asset, their time. In today's video, we are going to cover what key items our clients are asking us around their financial goals. Today, we are speaking with Pacific Portfolio's founder and CEO Larry Hood, as well as Jim Ayres, the Chief Investment Officer, about what questions they're getting from our clients.
So Larry, why don't you share with us one of the number one questions you're getting from our clients these days?
Well, thanks, Lisa. I think the main question we're getting right now from most of our clients is around the risk in their portfolio and the allocation they have to equities. The market's moved up a lot. People are a little concerned about valuation. And clients, especially putting new money to work, want guidance around that. All of our clients have a strategic allocation that fits their risk profile and circumstances. And we really think it's better to be fully invested at all times. So what we're doing with new money is we're averaging that in over a number of months, 3 to 6 months. And then we'll take down correction in the market of 5%. As an opportunity to go 50% allocated to the equities and the strategy. And then a downturn of 10%, we would go all in based upon our outlook for the next 12 months.
Jim, from your perspective as CIO, do you have any comments?
Yeah, thanks, Lisa. Investors certainly do seem to have a lot on their minds these days, just judging by the increase in the volume of questions we're getting lately. Typically, most of these tend to tie back to a couple of key themes. First and foremost being, what is our outlook for 2021? As Larry mentioned, we are relatively optimistic for the markets this year. But people want to know how they should be positioned, what are the areas they're going to want to either focus on or perhaps avoid. And really it comes down to this relatively favorable backdrop that we see. Economic growth has continued to recover. We see that continuing, particularly as vaccination process continues. And the economy comes back to something a little bit closer to more normal. We think we're going to continue to see activity pick up. But when you add on top of that the policy environment that we see with incredible monetary support coming out of not just the Fed, but central banks worldwide, putting a lot of liquidity into the system, and the stimulus packages, the fiscal packages being put through right now as we speak, we think the conditions really are there to help not just drive the broad equity market as a whole, but when it comes to how people should be positioned, it's important that they understand, first and foremost, it is about the long term, it is about discipline and strategy, but with a more near-term view, don't get stuck looking at what was happening last year. Last year was the year of U.S. stocks, it was large cap, it was growth stocks, it's a relatively narrow market. Increasingly, what we're seeing, what we think we're going to continue to see is a much broader market. Some of the areas that were neglected and got relatively depressed last year are already starting to pick up, and we think that will continue. These are areas like small cap stocks, value stocks, things that are more tied to the economy, more cyclical, things that benefit from lower rate environments, cheaper access to credit. While we think large cap growth will continue to do very well, we think a lot of these other areas that investors have been less focused on and less drawn to over the last 12 months during the COVID crisis really are going to be the places to be this year. And the other side of that coin, obviously, is where do we think they should not be? Well, kind of touching on what Larry was talking about with regard to investing clients, it's cash. We think cash is probably going to be the least productive asset this year. It is important, as Larry said, to be disciplined and to gradually step into the market when you're bringing new cash in. A lot of investors, unfortunately, have allowed themselves to get drawn to the sidelines. They panicked last year when the market went down into a bear market, and a lot of them have been having trouble getting back in. That's something we can help them with. Thankfully, we were able to talk most people off that ledge and keep them invested in their strategy. Unfortunately, some people find themselves in that predicament. As Larry was describing, there are a number of things we can do to help people get back to a disciplined, diversified strategy in an orderly way, rather than trying to time the market.
Great. I'm going to throw a question out there about real estate investments. What are your thoughts on that, Larry? Let's go to you first.
Well, I think I'd answer that in a couple of ways. In a diversified portfolio, our real estate allocations are into REITs, real estate investment trusts, which are companies that own and operate real estate but also trade like stock, and they're pretty interest sensitive as well. So given our outlook going forward, we're not very high on that asset class at this point. In fact, we've taken a zero allocation to REITs at this time. Having said that, there are still pockets in the REITs that will probably do well, the data storage, the industrial, the warehouse type space. But there's a lot of pitfalls in the commercial real estate, certainly retail real estate, that we're just avoiding at this point. We'd rather own equity than REITs. Now, having said that, I think if you look at the real estate market, the more direct investing market, that's going to be, we think, still pretty positive, especially if you're looking at whether or not you should purchase a home at this time or not. It's still going to be market driven. Probably some of your bigger markets, I think, will be in trouble, like New York, Los Angeles, San Francisco, the ones that have been elevated. But I think in general, this is a good time for people to be looking at either buying a home or stepping up in class on a home, primarily because of the cheap interest rates and the money that's available. These are historically low mortgage rates, and you buy a lot more house in this environment than you might be able to 2 or 3 years down the road.
Yeah, the rates are sure are low. Jim, do you have any additions to that?
I think Larry hit it on the head. It will definitely be a different market than we've seen, in the sense that some of the hotter areas may not be quite as hot. I think being able to work remotely has shown a lot of people they don't necessarily need to live in an urban center as much as they thought they did previously. So you may see more of this migration to some of the more suburban areas picking up. But certainly from a policy perspective, as Larry mentioned, we're seeing incredibly low rates. We think they're going to stay that way, but it presents an environment. If you think about continued economic growth, continued job creation, and very low interest rates, it's a very supportive environment, we think, for the housing market.
So every year, people change jobs, retire, sell a business. What should people be thinking about, Larry?
Well, I think from a financial planning and wealth management standpoint, they ought to be thinking about developing a plan and having a long-term strategy, and let that really help remove all the short-term noise from the situation. So they should be thinking about their goals, objectives, the lifestyle they want to have, and then they should also think about their risk preferences and risk profile, their ability to take risk, and then have a plan built that brings all of that together and coordinates it to give them the strategy and the outlook that will make sure that they're hitting their goals. They should be dynamic in that. That process should be dynamic. In other words, it shouldn't be a plan that's done every once and then looked at again 10 years later. It ought to be updated. It really should form the benchmark for them on how they're doing. I mean, they shouldn't be trying to beat the S&P or outperform foreign stocks or any of that. They should have a plan, have that be the benchmark, and then continually monitor how they're doing against that. I think that takes a lot of the emotion out. It helps them stay a longer-term view, and gives them that increased value of time that we're trying to provide.
And would you say having the plan in place prior to a major life event is important?
I think it's always better to plan early. And I think, that's certainly what we've done with a lot of clients. We've helped them evaluate different scenarios for maybe selling a business or keeping a business or, inheritance, family money. When should you start planning? Should your children have financial plans? The answer is yes. I mean, especially as they become adults. So I think the earlier you can start planning and the more thought you put into it, the better.
Thank you. I'm going to transition over to our final topic, and Jim, I'm going to have you take the lead on it. It's the new administration and taxes.
Well, okay, you're right. Taxes are typically the first thing that our clients are thinking about when they start considering the new administration. And frankly, our view on that topic, it really hasn't changed a whole lot over the last 12 months or so as we started to consider the possibility of a new administration taking over. Really, it's shaped by what we've seen over the course of the last year or so. We went from an economy that was doing pretty well to near complete shutdown. And the recovery has been going well, but it's going well as a result of a lot of the policy decisions being made. And we think any administration needs to be mindful of recovery. A move to increase taxes this year, we think, would be rather foolish. It would do too much towards sucking the momentum out of this ongoing economic expansion. We don't think the current administration is going to make that move. Higher taxes, frankly, are inevitable at some point. There's no question. We don't think it's going to be this year, though. Sometime next year, I think it's a lot more likely you'll see measures put in place that attempt to reverse some of the rollbacks we saw over the prior 4 years. But it's not something we're worried about in 2021, at least. I think more timely with regard to the current administration is what's going on the stimulus front. So you've got the Democratic Party with pretty good control over the various branches of government, and they've got a pretty big agenda on the stimulus front. Frankly, our view of that is that it's a good thing. We think we need to see bigger and faster stimulus right now to keep this economy going. We've seen kind of jobs start to falter a little bit, confidence start to fall a little bit, which is not alarming to us. We think you had this massive surge off of the recession trough. We think that pace needs to moderate, and it will get better as the vaccination process continues, but we need something to keep things afloat here in the meantime. The stimulus that we think we're going to see out of the Biden administration should go a long way towards doing that. Now, the last point I'll make is kind of a longer term view with regard to this, which is, look, we're spending at a pace that is not sustainable. It is, we think, vitally necessary right now, but we're going to pay the price for it down the road. Deficits are going to be higher. As long as interest rates are low, that's a manageable deal. And we think interest rates are going to stay low for quite some time. Somewhere down the road, though, yes, we're going to have to tighten up the belt a little bit. That's why, in part, we think higher taxes are unavoidable. But it's not something we see happening anytime soon. We don't think we're going to see any kind of debt crisis or currency crisis here in the U.S., particularly given the safe haven status that our securities enjoy.
Great. Larry, do you have any final topic? Any final comments?
Well, I'd just follow on to what Jim talked about and take more of a planner's perspective there in terms of, we know there's going to be change. And as we get more clarity on what that change will be, we'll be able to incorporate that into planning and help our clients figure out how they should maybe adjust their plan to take advantage of that, or at least not be disadvantaged any more than they should be by the changes. There's probably going to be changes in estate planning, taxes, and it will have an impact on timing, probably more than anything, timing of distributions out of retirement plans or deferred plans, timing for gifting for estate planning purposes, etc. So I think it's going to be a very dynamic 3-4 years, and that's kind of the fun of it. We get to help people plan and take advantage, or at least make sure they don't get hurt by these changes as they develop.
Thank you, Larry and Jim, for your time, and I thank you, everyone, for joining our video today. If you'd like us to send you a recording of our last investment outlook for clients or would like to set up a private consultation with a senior member of our team, please click the link below. Thank you and have a great day.